Hello and welcome to Investing Confidential. So the big question is the trade war over, right? Um, the last few days have been just about the Middle East, and they've been about what really is going to matter. Is it the budget talks, right? The tax bill, the budget. This is going to be the big noise and the big focus, as it should be, over the next weeks, months, whatever. So the trade war, I mean, look, I mean, at the end of the day, this was all about China. Uh, China cut a deal. We know the details. It's 90 days, but pretty much China has cut a deal. European Union is next. Trump is going to play very, very much hardball with the European Union, especially if he has China in his pocket. And so again, but at the end of the day, as I said, this is all a sideshow. It doesn't matter. Uh, both sides are going to give in. Nobody wins a trade war. But right now, in the game of chicken, look, bottom line, Trump is winning. Okay, that's the bottom line. And but in the end, nothing really matters because it's all about the budget. It's all about the tax, and it's all about this. I'm going to show this. You guys may not like it. I don't care. Uh, every time I show it, it's 100 billion, 200 billion, 300 billion, 400 billion higher. We're going to hit 37 trillion probably in a couple of weeks, and there is no end in sight. Even with what they calling the big beautiful bill, it's a ridiculous name for it, but all this is gonna all this bill's gonna do is accelerate this. The budget deficit with this bill is gonna go to 2.5 trillion. This is insanity, and it looks like the Republicans, some of the hardcore Republicans, are not going to vote no matter what they come up with. They're trying to cut deals left and right. I mean, in the end, this is for what it's worth. Okay, in the end, if this thing ever gets through, it's going to be typical Washington D.C. pork. Okay, just a bill full of gimmies to every congressman and senator there is. It's a disgrace, an absolute disgrace. While the debt goes higher and higher. Now, I got to hand it to the administration. They're trying to grow the economy. They're trying to cut expenses. They're getting, I mean, the opposition part of the Democrats is fighting them all the way. Democrats don't care. They don't care. Because if it was reversed, it'd be the same situation. Republicans fight. The whole political class is a disgrace. At some point, I hope Americans wake up to it and just get rid of them all. We need common sense people that are going to look at things in a common sense way. Say, because, this is really what the focus is going to be, and everything around it. Okay, the financial markets are moving. They're moving. While these morons are sitting in there in Capitol Hill negotiating a bunch of pork, because that's really what it is. It's a bunch of pork. And at the end of the day, look, I got to give it to the administration. I mean, not that I believe any of these numbers, but again, as I told you, the betting numbers are more reliable. We went from almost a 70% recession. Now we're below 40. Why? Well, the economic numbers that are coming in are better than expected across the board. And there's no denying it. Now, as I told you, I don't believe any of the economic numbers. I'd rather believe the betting markets. So the betting markets are telling you that the numbers, the government, now remember, the betting markets are looking at the government numbers, CPI, all the numbers, which are meaningless because anyone who knows anything knows that the Main Street has been in a recession for some time. But the bottom line is that this administration can possibly avoid, looks like they're betting that they're going to be able to avoid recession. Now, for those bulls out there who have been, begging the Fed, including Trump, by the way, to cut rates, it ain't going to happen. Now even, you know, Wall Street is coming to the reality that the Fed is not going to cut anytime soon, despite better or what was considered today a big low, a big positive CPI. I don't mean it was low, 2.1 or whatever the hell it was. It really doesn't matter. But so even a good CPI number is not getting people off the fact that the Fed is just not going to cut. Okay, he's not going to cut. And put everything in perspective, folks. Here is a 30-year, almost 40 years, maybe longer, of the 10-year bond yield. We're at 4.5%. Now, going back to the mid-'80s, we were at 10% on the 30. It was one of the greatest investments of all time. Imagine you could put a zero coupon bond compounding at 10% over 30 years. I mean, there's no better investment ever in the history of investments. Zero risk, compounding at double digits, fantastic. That's gone. As you can see, we went from amazing to absurd with the 10-year at 50 basis points. I mean, absolutely ridiculous. And now we're at 4.5. Now, no matter what has happened over the last month, 2 months, 3 months, it's not budging, because the bond market realizes that this is probably the terminal level. This is a good level for a 10-year bond. This is what you have to have: positive interest rates for an economy to work properly, no matter what the politicians want. So get used to this. Get used to 6% mortgages, because that's the way they used to be. 2% mortgages are ridiculous. Even 4% mortgages are ridiculous. You can't, and this is why the real estate bubble happened. Okay? And another reason why rates probably won't go down is you have still a massive amount of foreigners. Now the EU was China. China's been selling. Japan's been selling. Now here's the EU with big chunks of treasuries and corporate bonds. And most likely the EU, because of the weakened dollar, they're going to start selling. So the pressure on interest rates will be there. It's not going away, no matter what the CPI says. And speaking of the CPI, again, this is a very long-term chart. Okay, look at this chart. It goes back to early 1900s. Where we should be. We should be at 2.5%, 3%. That's healthy, believe it or not. 2.5%, that's healthy. That allows companies to raise prices slightly. But unfortunately, the actual CPI, meaning the growth in these baskets, is healthy, but you need some deflation to offset what we had a big spike in inflation. So most likely the CPI is going to actually come lower. We're seeing that trend. And that's not going to be positive. That's not going to help you. But we're at a level where we should be over the last 100 years. This is where CPI should, 2.5% to 3%. That's the range. You're going to have spikes, but this is where. So people are calling for all these people looking for really low inflation. It's not going to happen. It's not going to happen. And unfortunately for the average consumer in the U.S., the big problem is not CPI anymore. It's the dollar. The dollar has lost 80+% against gold. This is what's telling you what the real value of the dollar is. Because it's losing not against gold, but other currency. The dollar has been debased, and it's been debased because of the debt. Not because of Trump, not because it's the debt. And it didn't matter who got elected, this was inevitable. Now, can gold go higher? Sure it can. Significantly higher? Not so sure. It's had a massive run. Remember, gold is not Bitcoin. Gold's been around for 3,000 years. It's steady. Goes up, goes down, but steady. Outperforms all fiat currencies over the long term. So most likely this huge spike is a reset. So it's not going to go significantly high, but it's resetting. It's resetting. Now I'm going to talk about two opportunities. One, stay away and run away from. The other could be very interesting opportunity to take advantage of if you have some spare cash. First one to stay away from, folks, the this is a joke. The China and Hong Kong IPOs in the U.S. They're surpassing all the. I mean, by the way, this is one of the lowest IPOs years in 30, 40 years. But China and Hong Kong, which are the same thing, you know, have ramped up. And these are all micro, small caps, folks. Stay away from them. Over time, all of these Chinese IPOs, with the exception of Alibaba and a couple, have been a disaster. Stay away from any China IPOs. The economy there is still a mess. Now, what should we be looking at? Well, given all what has gone this week, I think it's an interesting opportunity. And nobody's talking about it because people are talking about Saudi investing $1 trillion here. Now, whether they invest $1 trillion here over the next 2 years, 3 years, 4 years, 10 years, remains to be seen. But they made the commitment. Okay. But what this is really about, folks, though, it's about Saudi. It's about the Middle East confirming, or not confirming, but trying to sell this stability, a place of stability, where it has been a place of just volatility and war for 100 years, 200 years. In fact, 2,000 years. Read about the Crusades. And so with all this wealth, with all the building, with all the investment overseas, Saudi does not want to become like a South Korea, doesn't want to become a Russia, doesn't want to become anything. They want to be Saudi. So if you look at here, this is Saudi versus emerging markets. Saudi's been outperforming quite comfortably for the last 3 or 4 years. Why is this significant? Because Saudi, according to the MSCI, and the MSCI is a bunch of morons in Europe that dictate where money's being allocated. Don't ask me why, but that's the case. Saudi's considered a frontier market. Most likely now, with all of this going on, there is going to be petitions to pump them up to what they call emerging index. If they go from frontier to emerging, there is an estimate anywhere from 500 million to 5 billion that could pile into the market. And it's not a big market. There's 253 companies plus another 70 kind of off-market, OTC, if you want to call it that. But that's significant because Saudi does restrict the amount of money coming in, and most likely that's going to be taken away, and that's going to be the trigger. So there's going to be a lot of money flooding into Saudi, and there's iShares, ETFs from BlackRock. So take a look at it, wait for bad news, and buy it. Could be very interesting. So in the end, the focus is the trade war is over. I'm telling you, trade war is over. Trump's going to smash Europe. The trade war is over. And the focus is going to be on the budget, the tax, this big, beautiful bill, whatever the hell it's called. And that's, for the next few months, that's basically how you got to trade the market on that kind of news. But the opportunities, again, folks, for buying and holding and investing is outside the U.S. It's not here. The dollar's a mess, and no matter what has happened, the dollar will continue to be a mess. So focus, as always, outside the U.S. And as always, investors, be careful out there.